Hey guys, welcome back to the channel. I'm Luke. Today we're going to be discussing some of the benefits of being a private company over and above being a public company. We're going to discuss the lower disclosure and regulatory requirements that managers benefit from being outside of the public view. We'll discuss the ability that managers have to be able to focus on medium and long-term strategic objectives as opposed to being under the pressure of short-term shareholders in the public market. So yeah, we'll discuss all of those things. This is a topic that comes up in the corporate issuers section of the material. So yeah, let's get into it. Okay, so the main benefit to company managers when it comes to private over public ownership models is that they have fewer shareholders and also fewer stakeholders to whom they are accountable to. So when you're a public company, you naturally bring on more stakeholders that you need to report to, deliver value to, account for. You know, when you think about stakeholders, you're not just thinking about the owners and the lenders to the business, you're thinking about like the government, employees, regulators, all your ESG considerations. It's a much broader number of individuals and entities that you are accountable to. Whereas when you're a private company, obviously you still have owners, you still have lenders and employees, but there tends to be a lot lower in terms of accountability requirements. And there tends to be a bit of a lower focus from the broader, more removed stakeholder groups as well. So there's definitely less accountability for managers. And then we have disclosure and reporting requirements. So the reporting pressures and deadlines on private companies are significantly lower and less cumbersome than what public companies face. You know, when you think about public companies, the likes of Apple, Facebook, etc., they have to report quarterly earnings, annual earnings. Private companies don't need to do that. You know, public companies need to provide information to their investors, to the regulators on a periodic basis, whereas private companies, as the name suggests, benefit from significantly greater privacy. They don't need to report every material matter that occurs to the market. They can maintain secrecy, and this means that the costs are kept lower for private companies. There's less time that senior management needs to tie up in thinking about reporting and disclosure and presenting to investors, you know, investor relations. And it also means that private companies reveal a lot less to competitors. When you think about public companies and the frequency with what they're reporting and the content of what they're reporting their numbers, their strategic priorities, their cost base, their efficiencies, their inefficiencies. There's so much more in terms of trade secrets that they have to release to the market, which competitors can utilize and benefit from. Whereas private companies, because they're releasing less information, they're not revealing as much to competitors, which gives them more of a competitive advantage within their industry and sector. Yeah, and a few other points here. So private companies allow managers to focus more on the long term. So they're able to focus on long-term strategic objectives and you know, the long-term health and prosperity of the company, whereas public companies tend to focus a lot more on the short-term objectives, because shareholders in public companies typically demand results much quicker. They want to see immediate financial returns, you know, within quarters as opposed to years. So because public company shareholders are impatient, they pressure management into prioritizing short-term objectives, which are potentially to the detriment of the long-term health and prosperity of the firm. So being private allows the CEO and senior management team to take a much longer-term view when it comes to developing and working on strategic priorities, instead of being pressured into producing quarterly results. They can focus on the medium to long term. So that's one of the benefits of being a private company. You're not trying to deliver every quarter deliver a return to shareholders, you can focus a lot more on the long term. Obviously, owners in a private company still want to see results, but being a private company allows management to really develop and build out a long-term thesis for the company. And just a few final points here. Private companies tend to be earlier stage, and as we know, earlier stage companies may offer higher return potential, but they also carry significantly higher risk. So, if you're an early stage growth-led company, you can offer investors higher returns if it all works out. But as we know, many early stage companies run the risk of failure because they're nascent, they're burning cash, they're investing a lot of capital into high risk industries and strategies. So private companies tend to be more nascent, which offers higher return potential for investors, but also comes with higher risk, whereas public companies tend to be more developed, mature companies, which are lower return but lower risk. So yeah, that's everything I wanted to cover in this video. That's some of the benefits to management teams of operating as a private company as opposed to operating as a public company. Hopefully that was helpful. Any questions, feel free to fire them off in the comments, and I'll see you guys in the next video.